Hello everyone, welcome back to Swadhyay. In the previous video, we have revised the chapters clubbing, set off and carry forward of losses. So today, we are going to head to the next chapter, that is deductions from gross total income. So after adding up all the incomes from all the heads, while computing the tax liability, we are going to arrive at a figure called gross total income. Deductions are provided from such gross total income. Deductions are reduced from the amount of gross total income to arrive at total income of the assessee on which tax liability is computed. So deductions in relation to chapter 6A and section 10A of Income Tax Act refers to the amount that is reduced from gross total income to arrive at the total income. Deductions are not allowed under the default tax regime, except only deductions under section 80 CCD 2, that is employer's contribution to pension scheme of central government, 80 CCH 2, that is central government's contribution to assessee's account in Agnivir Corpus Fund, and section 80 JJA would be available if the eligible assessee pays under the default tax regime. Deduction is allowed on specific investment or expense incurred by the taxpayer to promote the culture of savings and investments. So, generally, deductions are either related to any investment or expenditure made by the assessee, or deductions are with respect to any income of the assessee. Deductions under the Income Tax Act are allowed on specific investment or expenses incurred by the taxpayer so as to promote the culture of savings and investments. Moreover, section 80A states few conditions to claim deductions. Deductions cannot exceed gross total income. The total income after deductions will either be positive or nil. It cannot be negative due to deductions, and loss as a result of deduction cannot be carried forward for the purpose of set-off against income in subsequent years. While providing for deductions, we have to see that deductions should not exceed gross total income of the assessee. The total income after deductions will either be positive or nil, but the total income cannot be negative. And any loss incurred as a result of deduction cannot be carried forward for the purpose of set-off against income in the subsequent years. No deductions are allowed if any assessee has claimed deduction under section 35 AD. So generally deductions under chapter 6A and exemptions as per section 10 AA are not allowed under the default tax regime. Similarly, deductions are not allowed if any assessee claims deduction under section 35 AD, the one we have revised in the chapter PGBP. Except for deductions under section 80 CCD 2, which relates to employer's contribution to pension scheme of central government, 80 CCH 2, central government's contribution to assessee's account in Agnivir Corpus Fund, and section 80 JJA, all other deductions are not allowable for assessee if he pays tax under the default tax regime. These deductions are allowed under the default tax regime as well as optional tax regime. But if assessee has to claim other deductions under chapter 6A, he has to opt to pay tax as per the optional tax regime instead of default tax regime. Also, deductions are not allowed from long-term capital gains under section 112A or 112, short-term capital gains under section 111A, 111A, and also casual income such as lottery, winning from horse races, betting, gambling, etc. From such incomes, deductions are not allowed. So let us see what are the deductions from investment or expenditure made by the assessee. The first section under this chapter 80C, which states about deduction in respect of investments in specified assets. Deduction under 80C is available to individual. He can claim this deduction with respect to himself or spouse or children, and in case of HUF, for any member of the HUF, Section 80C deduction can be claimed. The maximum limit of deduction under 80C is Rs 1,50,000. Maximum limit of deduction under Section 80C is Rs 1,50,000. The following are the eligible investments under Section 80C. The first one is LIC premium. If LIC premium is paid by the assessee and the policy issue date is on or before 31st March 2012, the premium paid to the extent of 20% of sum assured can be claimed as deduction. Either the premium amount should not exceed the 20% of sum assured. So, if assessee wants to claim deduction with respect to LIC premium paid by him, he can claim deduction under 80C up to the 20% of sum assured in the policy. I hope you are able to understand. Similarly, if the policy is taken between 1st April 2012 to 31st March 2013, the premium to the extent of 10% of sum assured in the policy can be claimed as deduction under Section 80C. If the policy issue date is on or after 1st April 2013, premium to the extent of 10% of sum assured can be claimed under 80C, but in case the policy is taken on any disabled person, this limit will be 15% of sum assured. That means premium payable, the deduction on premium paid to the extent of 15% of sum assured for disabled persons can be claimed. This is the first eligible investment under Section 80C. The others are as follows. Contribution in unit linked insurance plan or LIC mutual fund. Contribution to statutory provident fund, recognized provident fund or public provident fund. Contribution to approved superannuation fund. National savings certificate. Approved annuity plans of LIC. Notified units of mutual funds or UTI or notified pension funds set up by mutual funds or unit trust of India. Payment of tuition fee. Maximum of up to 2 children, maximum for up to 2 children for full-time education within India. Housing loan principal repaid for any house property borrowed on which loan is borrowed for purchase or construction of house property, and such house property should not be transferred within 5 years. The condition is housing loan principal repaid. The principal portion which has been repaid can be claimed as deduction. Such housing loan should have been borrowed for purchase or construction of house property, and such house property should not be transferred within 5 years. Investment in 5-year post office time deposit or term deposit. NABARD bond, senior citizen savings scheme. Contribution to additional account of Tier 2 in NPS, which is applicable to central government employees. National Housing Bank tax savings scheme. Equity shares or debentures of intra-development undertaking, and the minimum lock-in period for these shares or debentures is 3 years. If the shares or debentures are transferred before such lock-in period, the amount so realized is treated as deemed income and hence taxable. Contribution to Sukanya Samriddhi scheme in respect of girl child of the individual or in respect of girl child for whom such assessee or individual is legal guardian. So these are eligible investments under Section 80C. And the maximum amount of deduction that can be claimed by the assessee with respect to all these investments is Rs 1,50,000 only. Now let us head to the next section, that is Section 80CCC. 80CCC is regarding contribution by the assessee to certain pension funds. The eligible assessee to claim the deduction under Section 80CCC is individual assessee, and he can claim deduction only under optional tax regime. The maximum limit of deduction that can be claimed is Rs 1,50,000. And the eligible investment under section 80 CCC is annuity plan of LIC or other insurer which is not covered in section 80C. In section 80C above, the annuity plan of LIC is not covered. Similarly, annuity plan of any other insurer, if assessee invests in such annuity plan of LIC or other insurer, he can claim deduction under section 80 CCC. But the maximum limit will be 1,50,000 rupees only. The amount received on maturity or surrender or withdrawal of such policy is taxable on receipt basis. Whenever such amount is received, it is taxable under as per the Income Tax Act. The next section talks about contribution to new pension scheme. Contribution to new pension scheme. So, when assessee contributes towards NPS, as per section 80 CCD 1, the maximum limit of deduction that can be claimed by the assessee is either amount contributed to NPS or maximum the amount contributed to NPS, which is limited to maximum of 10% of salary in case of salaried person. If the assessee is salaried person, maximum of 10% of his salary is the limit of deduction, and amount contributed to NPS shall be deducted subject to such limit. In case he is other than salaried person, he is self-employed, 20% of his gross total income is the maximum limit which can be claimed as deduction with respect to amount contributed to NPS by the assessee. The next section is section 80 CCD 1B. The eligible assessee is individual, and additional deduction on assessee's contribution to NPS scheme can be claimed under section 80 CCD 1B. That means over and above the limit specified in 80 CCD 1, additional deduction of rupees 50,000 can be claimed by the assessee on his own contribution to National Pension Scheme. First deduction he can claim as mentioned under section 80 CCD 1. Over that, additional deduction can be claimed by the individual assessee under the optional tax regime of rupees 50,000 on his own contribution towards the new pension scheme. The next section is 80 CCD 2. Section 80 CCD 2 is with respect to deduction on employer's contribution. It deals with deduction on employer's contribution to new pension scheme. This deduction is available for individual who pays tax both under the default tax regime as well as optional tax regime. The maximum limit of deduction that can be claimed by assessee, the individual, under 80 CCD 2 is amount contributed to NPS, but such amount is limited to either 14% of salary in case of central government or state government employee or 10% of salary in case of other employees. Note this point, 80 CCD 2 section is applicable only on salaried employees. Since the deduction is with respect to employer contribution, the salaried employees can claim deduction on amount contributed to NPS by their employer up to either 14% of the salary in case of central government or state government employees and 10% of salary in case of other employees. I hope it is clear for you. Withdrawal of NPS scheme. When amount is withdrawn from the investment into the NPS scheme, the amount invested into the NPS scheme is withdrawn. On such withdrawal, if the amount is received on death of subscriber by the nominee, here nominee is withdrawing the amount on the death of subscriber to NPS scheme, then such amount will be fully exempt. But when the amount is withdrawn by the assessee himself, in case of closure or opt-out scheme, that means the whole amount is withdrawn, then 40% of such amount will be taxable and 60% is exempt. 40% is taxable and 60% is exempt of the amount withdrawn from the NPS scheme. In case of partial withdrawal, then 75% of such amount is taxable and 25% is exempt. It is fully taxable for non-salaried assessees. The amount withdrawn is fully taxable for non-salaried assessees. The next section, 80CCE. 80CCE limits the maximum deduction under section 80C, 80CCC and 80CCD1 to rupees 1,50,000 only. That means if assessee invests under all these eligible investments mentioned under section 80C, after that on assessee's contribution to certain pension fund and assessee's contribution to new pension scheme, the maximum amount of deduction that can be claimed by him is rupees 1,50,000 only with respect to 80C, 80CCC and 80CCD1. The additional deduction on assessee's contribution 50,000 can be claimed irrespective of the limit mentioned in 80CCE, as well as the employer contribution. The deduction on employer contribution as mentioned under section 80CCD2 can also be claimed irrespective of limit mentioned under section 80CCE. This limit is applicable only to 80C, 80CCC and 80CCD1. Together, under all these three sections, assessee can claim a maximum of rupees 1,50,000 deduction only. The next section, section 80CCH, deduction with respect to contribution to Agniveer Corpus Fund. If an individual is enrolled in the Agnipath scheme and subscribes to Agniveer Corpus Fund on or after 1st November 2022, who has paid or deposited any amount in his account in the Agniveer Corpus Fund, he is eligible assessee to claim deduction under section 80CCH. This Agniveer Corpus Fund is a fund for those youth working in the armed forces. When the assessee's contribution is made to the Agniveer Corpus Fund, it is allowed as deduction only under the optional tax regime. But if central government contributes to such scheme for the assessee on the account of assessee, it is allowed as deduction under both the regimes, both under the optional tax regime and default tax regime. What is the amount of contribution to this scheme, to this fund? Each Agniveer is to contribute 30% of his monthly customized Agniveer package to individual's Agniveer Corpus Fund. Further, the government will also contribute a matching amount to Agniveer Corpus Fund. First, the Agniveer, that is the person working in the armed forces, will contribute 30% of his monthly customized Agniveer package, that is 30% of his monthly salary, towards the Agniveer Corpus Fund. And such equal amount will also be contributed by the government towards such account. Individual's contribution is allowed as deduction only under optional tax regime, whereas central government's contribution allowed as deduction under both the regimes. Also, any payment from the Agnipath Corpus Fund to a person enrolled under the Agnipath scheme or to his nominee would be exempt from tax. There is an exemption with respect to any payment made from the Agnipath Corpus Fund either towards the assessee or towards his nominee. It will be exempted from tax. This is all about section 80CCH. Now, let us discuss the next section, 80D, which talks about medical insurance premium paid by the assessee. So, under section 80D, the eligible assessee is either individual or HUF. He can be resident or non-resident, and he has to pay tax under the optional tax regime, that means opting out of default tax regime to claim deduction under section 80D. The eligible expenditure is medical or health insurance premium paid, payment in central government health scheme, and this payment can be made only with respect to the assessee himself or his spouse and children. It is not applicable for the parents of assessee, or in case of HUF, if payment is made in central government health scheme for members, it is not such expenditure cannot be claimed as deduction. Also, if the eligible expenditure under section 80D is preventive health checkup expenditure, the expenditure incurred on preventive health checkup can also be claimed as eligible expenditure. Medical expenditure for resident senior citizen. Let us see the extent of deduction that can be claimed by the assessee under section 80D. In case of individual, for his self or spouse or dependent child, maximum of rupees 25,000 can be claimed by the assessee. If in case the assessee or his spouse, any of them is resident senior citizen, he can claim up to rupees 50,000 as deduction with respect to medical insurance premium. In case of parents of assessee, he has paid medical insurance premium. In such a case, the maximum deduction that can be claimed is rupees 25,000. If any of the parents is resident senior citizen, the maximum deduction claimed could be rupees 50,000 if any of the parents is resident senior citizen. In case of HUF, the extent of deduction is maximum of rupees 25,000 for members and rupees 50,000 if any of them is resident senior citizen. The mode of payment of medical insurance premium should be in other than cash. Legal tender is not acceptable. That means cash payment is not acceptable. Preventive checkup payment is allowed in cash, but except for preventive health checkup payment, all other eligible expenditure must have been paid in mode other than cash to claim the deduction under section 80D. This is the condition. Preventive health checkup payment is allowed up to rupees 5,000 within overall limit of above. So, if assessee wants to claim the expenditure incurred for preventive health checkup as a deduction, he can claim up to rupees 5,000. But this 5,000 is included in above limits of rupees 25,000 or 50,000 as the case may be. This 5,000 expenditure can be claimed as part of above deduction. If health insurance premium is paid in lump sum for more than 1 year, instead of paying in installments, the premium is paid in lump sum for more than 1 year, then we will proportionately claim the deduction for every assessment year. The proportionate deduction amount is equal to the lump sum amount divided by the term of health insurance policy. Now let us discuss section 80U. Section 80U discusses about the deduction for disabled person. The eligible assessee is resident individual only, and 80U deduction can be claimed only under optional tax regime. The eligible assessee must be a resident individual, has a disability including autism or cerebral palsy. He has to furnish a certificate issued by the medical authority. The amount of deduction under section 80U is flat deduction of rupees 75,000, and in case of severe disability, over 80% of disability is existing. In such a case, maximum amount of deduction is rupees 1,25,000. So generally, the deduction amount is rupees 75,000, but in case of severe disability of the assessee, he can claim rupees 1,25,000 under section 80U. Only if the assessee is resident individual, is suffering from disability including autism or cerebral palsy, and he has to furnish certificate issued by the medical authority with respect to such disability. In such a case, he can claim deduction with respect to himself. Here, the disabled person is the assessee, and he is claiming deduction under section 80U. The next section is section 80DD. Here, the assessee is not disabled person, but a disabled person is dependent on assessee. So, deduction with respect to such disabled dependent. The eligible assessee is resident individual or HUF maintaining disabled dependent. This deduction is available only under optional tax regime, and amount of deduction is similar to Section 80U, flat deduction of Rs 75,000, or in case of severe disability over 80% or more, Rs 1,25,000 deduction is available. The eligible expenditure is medical treatment or nursing or training or rehabilitation. The assessee should have been deposited amount under a scheme of LIC or other insurer for maintenance of the dependent. In case of medical treatment or nursing or training or rehabilitation, as well as if assessee has deposited any amount under the scheme of LIC or other insurance for the maintenance of dependent. Such expenditure is eligible expenditure to claim the amount of deduction under Section 80DD. For individual assessee, the disabled dependent could be his spouse, children, parents, brother or sister who are wholly or mainly dependent, and they should not claim deduction under Section 80U. His spouse, children, parents, brother or sister who are mainly dependent on the assessee, and such disabled dependent should not claim any deduction under Section 80U. Only then the assessee can claim deduction with respect to such disabled dependent under Section 80DD. In case of HUF assessee, any member of HUF dependent on such HUF and not claiming deduction under Section 80U are eligible disabled dependent with respect to whom deduction can be claimed under Section 80DD. On death of disabled dependent, the amount received by assessee under LIC or other insurance scheme is taxable under the head income from other sources. Since the eligible expenditure also includes any amount paid by the assessee under LIC or other insurance policy, so amount received on the death of disabled dependent from the LIC or other insurance scheme will be taxable under the head income from other sources. Now let us head to the next section, Section 80DDB. Section 80DDB talks about medical treatment of prescribed disease. Here, the eligible assessee is resident individual or HUF maintaining a disabled dependent, and the amount of deduction is lower of actual medical treatment or expense either for self or dependent. Such medical treatment should have been incurred for the prescribed disease. The amount of deduction is lower of actual medical treatment expense for self or dependent or Rs 40,000. In case of resident senior citizen, instead of Rs 40,000, the limit could be enhanced to Rs 1 lakh. So in case of resident senior citizen, lower of actual medical treatment expense incurred or Rs 1 lakh can be claimed as amount of deduction. And if any insurance claim has been received by the assessee, such claim amount received should be reduced from amount of deduction. That means the expense incurred or Rs 40,000 or 1 lakh as the case may be, minus any claim amount received will be the amount of deduction under Section 80DDB. Now heading to the next section, that is Section 80E. Interest on loan for higher education. Under optional tax regime, only individual assessee who has taken educational loan can claim deduction with respect to interest paid on such educational loan. The education loan should have been taken for the assessee's education for the self or his spouse, children or student whose legal guardian is the assessee. So when assessee is acting as legal guardian for any student, he can claim for deduction under Section 80E when he has taken any loan for higher education of such student. The loan must have been taken in respect of higher education, that means after class 12. It should have been taken from financial institution or approved charitable institution. The amount of deduction is the interest portion. The interest portion which has been paid on the loan in the assessment year, in the previous year. It can be claimed till 8 consecutive years starting from the period when first installment was paid. Starting from the period when first installment was paid, the interest on education loan can be claimed as deduction till 8 consecutive years. There is no limit on interest on loan for higher education. There is no limit on amount of deduction with respect to interest on loan for higher education. The next section is 80EE, EEA and EEB. Let us discuss these three sections at once. 80EE and EEA are with respect to home loan, interest on housing loan, whereas section 80EEB deals with interest on electric vehicle loan, interest paid on electric vehicle loan. So the eligible assessee to claim deduction with respect to interest on housing or EV loan is individual who has taken loan to acquire residential house property from a financial institution, or the individual who has taken loan to purchase electric vehicle from any financial institution. Here financial institution does not include NBFCs in case of housing loan. Except for NBFCs, if individual has taken housing loan from any financial institution, he can claim deduction on interest paid on such loan. The conditions under section 80EE are: the value of house property should not exceed rupees 50 lakh. It should be less than or equal to rupees 50 lakh. Whereas the loan amount should not exceed rupees 35 lakh. The house property value should not exceed 50 lakh and the loan amount should not exceed rupees 35 lakh. It should have been sanctioned in the previous year 2016-17. And assessee is not owner of any other house. This is in case of the home loan should have been taken by the assessee who is buying any house property for the first time. Section 80EE and EEA are applicable to the assessee who is the first time buyer of any house property. The conditions under section 80EEA are: the stamp duty value of the house property should not exceed rupees 45 lakh. Under 80EE, the value of house property should not exceed 50 lakh and loan amount should not exceed 35 lakh. But under 80EEA, the condition is the SDV of house property should not exceed rupees 45 lakh. The loan should have been sanctioned during 1st April 2019 to 31st March 2022 and assessee is not owner of any other house property. These are the conditions under section 80EE and EEA with respect to housing loan. Heading to the section 80EEB. The financial institution from which the loan has been taken for electric vehicle can include NBFCs also. Even if the loan has been taken from NBFC, the deduction on interest paid can be claimed. The loan must have been sanctioned during 1st April 2019 to 31st March 2023. And no further deduction in other sections with respect to interest on electric vehicle loan is allowed. Only under section 80EEB, the assessee can claim deduction with respect to interest on electric vehicle loan. The deduction amount under section 80EE is maximum of rupees 50,000 only. But for under section 80EEA, the deduction amount is maximum rupees 1,50,000. Also, the maximum amount of deduction under section 80EEB is rupees 1,50,000. That means either the interest paid on such loan or the limits mentioned here, whichever is lower, can be claimed as deduction. Remember this important point. Deduction under section 80EE or EEA can be claimed over and above deduction under section 24B of rupees 2 lakh. If you remember, we have discussed in the chapter income from house property that under section 24B there is a deduction with respect to interest on borrowing. The maximum amount that can be claimed under section 24B is 2 lakh and over and above such 2 lakh, the either rupees 50,000 under section 80 EE or rupees 1,50,000 under section 80 EEA can be claimed by the assessee. Along with such 2 lakh amount, the deduction under section 80 EE or EEA can be claimed by the assessee. Now let us move to the next section, section 80G. Section 80G is regarding donations to certain funds, charitable institutions, etc. And for all assessees under the optional tax regime, section 80G deduction can be claimed. Under optional tax regime, any assessee can claim deduction under section 80G with respect to donations to certain funds or charitable institutions, etc. There are 4 categories of deductions under section 80G. The first one is 100% deduction of amount donated without any qualifying limit. The next one is 50% deduction without any qualifying limit. And the third one is 100% deduction of amount donated subject to a qualifying limit. The fourth one is 50% of deduction of amount donated subject to qualifying limit. The first category, 100% deduction without any qualifying limit on amount donated. If the donee, that means the donation is towards Prime Minister's National Relief Fund or National Children's Fund or Swachh Bharat Kosh, National Defence Fund, PM CARES Fund, etc. In such a case, the deduction amount is 100% of amount donated without any qualifying limit. In case the donation is towards Prime Minister's Drought Relief Fund, in such a case, only 50% of amount donated can be claimed as deduction without any qualifying limit. The third category, if the donation is towards government or local authority or any institution for promotion of family planning, etc., 100% reduction of amount donated is allowed subject to a qualifying limit. If the donation is towards government or any local authority to be used for charitable purpose, notified temple, church, gurudwar, mosque, etc., other than for promotion of family planning, in such a case 50% of deduction is allowed out of the amount donated subject to the qualifying limit. Since we are mentioning the term qualifying limit, let us see how this qualifying limit is calculated in the category 3 and 4 donations. Qualifying limit is nothing but we have to compute the adjusted total income. Adjusted total income can be computed by taking the gross total income of the assessee and providing for all the deductions under chapter 6A except for under section 80G. After that, we have to reduce the short-term capital gains taxable under section 111A. Under section 111A. We have to deduct long-term capital gains taxable under section 112 and 112A. So, after deducting these 3 items from the gross total income, we will arrive at adjusted total income. Take 10% of such adjusted total income. Now, in the third step, calculate the actual donation which is subject to qualifying limit. What is the actual donation amount under category 3 or category 4? Lower of step 2 or step 3 is maximum permissible deduction. That means either the actual donation or 10% of adjusted total income, whichever is lower, is the maximum permissible deduction. The said deduction is adjusted first against donations qualifying for 100% deduction. That means category 3 donation. Thereafter, 50% of balance qualifies for deduction under section 80G. After calculating the maximum permissible limit, first we are going to reduce such amount from 100% deduction, that means category 3 deduction, with respect to which 100% deduction can be claimed of amount donated. Then we will, whatever the balance amount is there, from such amount we are going to provide for deduction under category 4. That means only 50% of deduction of amount donated can be claimed from whatever balance of adjusted total income is there. Also, No deduction is allowed for donation in excess of rupees 2000 if it is paid in cash. If the donation is paid in cash and it exceeds rupees 2000, we will allow no deduction for such donation. That means even up to 2000 also, the deduction is not allowed if the donation is paid in excess of rupees 2000. The whole amount will be disallowed as a deduction under section 80G. Now let us discuss the next section, 80GG. So section 80GG is regarding rent paid is regarding deduction for rent paid for residential accommodation. The eligible assessee is individual who is not in receipt of house rent allowance and he is paying tax under optional tax regime. The amount of deduction with respect to such rent paid for residential accommodation is lower of 25% of his total income or rent paid minus 10% of his total income or rupees 5000 per month, whichever is lower of 25% of total income, rent paid minus 10% of total income or rupees 5000 per month, we are going to claim as deduction. Here the eligible assessee is the individual who is not receiving any house rent allowance from his employer. Hence we are not going to take salary as base while calculating the amount of deduction. Instead we are taking total income of the assessee as the base for calculating the amount of deduction, and the amount of deduction is lower of 25% of his total income or rent paid minus 10% of his total income or rupees 5000 per month. Also, no deduction is allowed if any residential accommodation is owned by the assessee or his spouse or minor child or HUF at the place where he ordinarily resides or performs the duties of his office or employment or carries on his business or profession. The assessee is residing at the place where the assessee is performing his duties or office or employment from the place where he usually resides, and such residential accommodation is owned by the assessee himself or spouse or minor child or HUF. In such a case, deduction under section 80GG is not allowed. The next section, 80GGA, which talks about deduction with respect to donations for scientific research and rural development. The assessee is not having any income chargeable under the head PGBP. So if assessee is any businessman or if he is carrying on any profession and he contributes any amount for scientific research to any third party like university or college, etc., as we have discussed under section 35 AD, he can claim deduction under the head PGBP itself. For the amount contributed by him towards such scientific research, he can claim deduction. But since the assessee is not having any income chargeable under the head PGBP, that means he is not carrying on any business or profession, but he is contributing some amount towards the scientific research or rural development. He is donating for scientific research or rural development. In such a case, the amount of deduction will be actual donation, and no deduction shall be allowed for donation in excess of rupees 2000 if paid in cash. If assessee pays in cash and donates in excess of rupees 2000, if assessee donates an amount in excess of rupees 2000 in form of cash, then we are not going to provide any amount of deduction for the amount donated by the assessee. Even up to the extent of rupees 2000 also, the assessee cannot claim deduction. The whole amount will be disallowed as deduction under section 80GGA. Section 80GGB talks about deduction with respect to contribution to political parties. The eligible assessee is Indian company, and Indian company is not opting for section to pay tax under section 115BAA or BAB. That means instead of default tax regime, the eligible assessee, the Indian company, is paying tax under optional regime. The eligible expenditure is any sum contributed by it to a registered political party or an electoral trust, and the amount of deduction is actual contribution made otherwise than by cash. If Indian company pays in cash, the deduction is disallowed. 80GGC talks about deduction with respect to contribution to political parties by any person other than local authority or an artificial juridical person funded by the government, and such person pays tax under the optional tax regime. In such a case, the eligible expenditure is amount contributed to a registered political party or an electoral trust. With respect to such expenditure, the amount of deduction is actual contribution by the assessee, otherwise than by cash. The next section, 80JJAA. It talks about deduction in respect of new employment, and this deduction can be claimed by assessee who is paying tax under both the default tax regime or the optional tax regime. The eligible assessee is all the assessee who are required to get books audited, tax audited under section 44AB. So the assessees who are getting their books tax audited under section 44AB are the eligible assessees. And if such assessee has employed additional employees in the previous year, he can claim deduction under section 80JJAA with respect to 30% of wages paid to new workmen. Whatever the additional employee cost, whatever the additional wages the assessee is paying to new workmen, out of that wages, 30% can be claimed as deduction. The deduction period is for 3 years relevant to previous year in which employment is provided. For 3 years, the assessee can claim deduction with respect to wages paid to new workmen up to 30% of wages. Additional employee means an employee who has been employed during the previous year, hence increasing the total number of employees employed as on the last day of the preceding year. The additional employee does not include an employee whose total emoluments are more than Rs 25,000 per month. If you are paying more than Rs 25,000 per month, such employee will not be regarded as additional employee. An employee for whom the entire contribution is paid by the government under Employees Pension Scheme or Employees Provident Fund and Miscellaneous Provisions Act 1952. If government pays any contributes for employees under such schemes, such employee will be not treated as additional employee. An employee who does not participate in recognized provident fund is not considered as additional employee, and an employee employed for a period less than 240 days during the previous year is not an additional employee. And this limit of 240 days is reduced to 150 days in case of an assessee engaged in the business of manufacturing of apparel or footwear or leather products. For assessee employer who is engaged in business of manufacturing of apparel, footwear or leather products, if he has engaged a new employee for less than 150 days in the previous year, then such employee will not be considered as additional employee. Only if he is engaged for more than 150 days, he will be considered as additional employee. If, note this point, if the employee is employed for less than 240 days or 150 days as the case may be in previous year, but he is employed for more than 240 days or 150 days as the case may be in succeeding year, such employee is deemed to be employed in such year, hence can claim deduction under section for 3 years starting from such year. In the previous year, additional employees are employed, but they worked for less than 240 days or 150 days in case of manufacturer of apparel, footwear, etc. So, if they are engaged for less than 240 days or 150 days in previous year, but in the succeeding year, they are engaged for more than 240 days or 150 days. In such case, the employees, the additional employees are deemed to be employed in such succeeding year, and from such succeeding year for 3 years the employee can claim deduction under section 80JJAA. I hope you're able to understand what I'm trying to convey. Now let us move to the next section, that is section 80QQB or RRB. Let us discuss both the sections simultaneously. These sections are regarding deduction of royalty, deduction with respect to royalty paid. And deduction under these sections can be claimed only for assessee who is paying tax under optional tax regime. 80QQB is regarding royalty from books, and 80RRB is regarding deduction for royalty for patents other than books. For royalty on books under section 80QQB involving regular royalty like for monthly, quarterly or yearly payments, the income should be less than or equal to 15% value of books sold. If the income exceeds 15% of value of the books sold, then no deduction can be claimed. And if the income is received outside India, the deduction is available if the income is received in foreign currency and if it is received within 6 months from the end of financial year. Also, royalty from textbook or newspaper or brochure or pamphlets on such on textbooks or newspaper or brochure or pamphlets, no deduction can be claimed with respect to royalty. And the eligible assessee under section 80QQB is resident individual who is author of books. For section 80RRB, the eligible assessee is resident individual and royalty is regarding patents for other than books. The deduction amount under section 80QQB as well as RRB is lower of either the royalty income or rupees 3 lakh. Either royalty income or rupees 3 lakh, whichever is lower, can be claimed as deduction under section 80QQB and under section 80RRB. Sorry. Now let us discuss the next section 80TTA or 80TTB. 80TTA is regarding deduction for interest from savings account and 80TTB is deduction with respect to interest on deposits. 80TTA is applicable for assessees who are individual, HUF, but not resident senior citizen. Individual or HUF can claim deduction under section 80TTA with respect to the interest they have earned on their savings bank account. But 80TTA is not applicable to resident senior citizen because the resident senior citizen is the eligible assessee under section 80TTB, interest on deposits. The deduction amount is lower of either interest received or rupees 10,000. Either rupees 10,000 or the interest received, whichever is lower, can be claimed as deduction under section 80TTA. In case of 80TTB, lower of interest received or rupees 50,000 can be claimed as reduction. Here the limit is rupees 50,000 or interest received, whichever is lower. Note: account can be with any bank or cooperative bank or post office. Here the savings account, the account can be either with any bank or cooperative society, bank or a post office, on which account the interest is earned. Now let us talk about section 10AA. So section 10AA, the exemption for SEZ units is available under section 10AA. The eligible assessees are manufacturer or service provider who derives profits from an SEZ unit which begins to manufacture or produce articles or provide any service on or after 1st April 2005 but before 1st April 2021. Also, it is available to such assessee whose SEZ approval is obtained up to 31st March 2020 and business is commenced up to 31st March 2021. The eligible income to claim this exemption is profits derived from exports of such articles or things or export of services including computer software. And the conditions to claim this deduction are: the proceeds are to be received in convertible foreign exchange within 6 months from the end of previous year or such further period as allowed by competent authority. The proceeds must be received in convertible foreign exchange, and that too within 6 months from the end of previous year. If there is an extension in this time limit, it will be allowed by competent authority, that is RBI. The report of practicing chartered accountant certifying that the deduction has been correctly claimed should be furnished before the date specified in section 44AB, that is 1 month before due date of return of income. Also, return of income to be filed on or before the due date under section 139(1). So, timely filing of return, a report from practicing chartered accountant that the deduction amount has been correctly claimed, proceeds should be received in convertible foreign exchange, and that too within 6 months from the end of previous year. These are the conditions to claim deduction under section 10AA. What is the permissible deduction? The deduction under this section can be claimed for 15 consecutive assessment years. But for year 1 to 5, in the first 5 years, the exempt amount would be 100% of such profits. For year 6 to 10, 50% of such profits are claimed as deduction, can be claimed as deduction. From year 11 to 15, either 50% of such profits or SCZ reinvestment reserve account balance, whichever is lower, can be claimed as deduction. The amount of deduction, that means what are the profits to be considered, the amount that has to be deducted under this section. The amount of deduction is profit of SEZ unit into export turnover divided by total turnover of such unit. Profit of SEZ unit into export turnover divided by total turnover of the unit. These are the profits on which either 100% in the first 5 years, 50% in next 5 years, and lower of 50% of profits or SCZ reinvestment reserve account balance, whichever is lower, can be claimed as permissible deduction. The SCZ reserve account, it is used only to acquire plant and machinery within 3 years from the end of previous year in which it was created. And SCZ reserve account balance should not be used outside India for distribution of dividend or profits. So this is all about section 10AA. So with this, we have completed revision of the chapter deductions from the gross total income. Further, let us discuss the other chapters in the upcoming videos. I hope you find this video helpful. Thank you for watching, and please do keep watch our videos regularly. Thank you.